Hello everyone. Right at the start of this video, we would like to inform you that we are not SEBI registered research analysts. The information we are sharing in this video is only for educational purposes and should not be treated as a buy or sell recommendation. In this video, we will talk about a fundamentally strong stock which is available at 18% discount from its 52-week high price. That's not all. This stock has recently gathered some momentum and might offer us an upside potential of 19%. The best part is that the downside risk seems to be limited. This would mean that the risk-to-reward ratio is attractive. First, we will look into the fundamentals of this company and then we will discuss the technical levels with the help of a chart. So, let's get started. Alright, so the company that we will talk about is a pharmaceutical business entity that was incorporated in 1991, and it is one of the largest vertically integrated pharmaceutical manufacturing companies in India. They produce and supply active pharmaceutical ingredients, pharmaceutical formulation intermediates, and finished dosages to major global markets, including the United States, Canada, Latin America, Europe, Asia Pacific, and India. The company has a vertically integrated business model, covering everything from APIs to finished dosages. This allows them to benefit from economies of scale and efficient manufacturing. Being present across the entire value chain makes them resilient in the face of competition, pricing pressure, and potential shortages of raw materials. Their strong research and development, compliant facilities, and impressive track record of approvals provide confidence in their ability to launch new products in various therapies. Coming to the valuations, with a price-to-earnings ratio of around 14 times, this stock offers a good margin of safety, especially when the sector price-to-earnings ratio is around 38 times. This company has 7 manufacturing facilities and employs more than 3,500 people. They serve more than 75 countries, with the US, Europe, and Canada accounting for around 70% of their revenue. The majority of their revenue comes from exports. Initially, this company focused on volume-based products, but over time, they have expanded their product offerings to include higher value segments, creating a unique product portfolio. They are preferred partners for leading branded and generic pharmaceutical companies worldwide. They have one of the largest pharmaceutical formulation intermediate facilities, and single-site finished dosage facilities in the world. Additionally, they own one of the largest paracetamol API facilities globally. The company we are talking about is Granules India Limited. It is a small-cap company with a market capital of around 7,500 crore rupees. P/E ratio is around 14 times. Return on equity is around 19%, and return on capital employed is around 15%. It has a very low debt-to-equity ratio of just 0.4. In the last 1 month, the stock gave a return of nearly 10% and in the last 1 year, it gave around 12% returns. In the previous fiscal years, Granules India had a bit of a slowdown when it came to getting approvals for abbreviated new drug applications. But here's the good news. Things have started to pick up for them in FY24. So far, they have already received 3 ANDA approvals, and they're hopeful about getting more approvals in the remaining period of FY24. What's interesting is that some of these recent approvals are for products that face limited competition, or products where Granules India has an advantage over their competitors in the manufacturing process. That's great news, because it means that they have a good chance of making sales from these approved products. In fact, they're expected to achieve potential sales of around $40 million on an annual basis from these recent approvals. However, we need to keep in mind that there might be some impact on these sales due to an IT security issue. Overall, things are looking good for Granules India. They have a positive outlook for their ANDA business in the United States, and they are also working on improving their core products like paracetamol and metformin by integrating them backward in their manufacturing process. With these efforts in place, we have a positive view of Granules India's future. The pharmaceutical sector has been doing really well in recent months. Many stocks that were previously down have already seen significant rise in their prices. However, Granules India has been lagging behind and hasn't shown much progress. But, on the last Friday, something exciting happened. Granules India finally broke free from its recent obstacles and showed a strong upward movement. This positive move was supported by high trading volumes and decent delivery percentage, which adds credibility to the upward trend. Now, we expect Granules India to catch up and make some progress in the coming weeks and months. Let's take a look at the chart and see how the stock price behaved in the last 1 year. This is a daily chart of Granules India on your screen. You can see that the stock went through a depreciation phase from November 2022 to January 2023. Then, it started consolidating from the month of February. It reached a high price of 381 in the past 52 weeks but fell to a low of 268, which is a big 30% drop. During this time, the Relative Strength Index, RSI, went below 30, showing that the stock was oversold. As it continued consolidating, it found support between 275 and 280 levels. From there, it started going up and last week, it closed above the important level of 300 rupees, confirming a bullish reversal. We can see that the volume increased and the RSI is now above 60. The recent delivery percentage also looks good. Considering the strong fundamentals of the company and the positive developments, there is potential for the stock price to surpass its 52-week high in the long term. In the short term, we believe the price can reach around 330, in the medium term around 350, and in the long term, the price can reach up to 370. We think it's safe to start with a small position at the current level of 310, and add more if the price falls to 300. Initially, we can set a strict stop-loss below 290, which means if the stock falls to that price, it's a signal to exit the trade. Once the price reaches our first target of 330, we can adjust the stop-loss to 315. Similarly, when our second target of 350 is reached, we can revise the stop-loss to 330. We should exit all positions when our third target of 370 is met. It might take between 3 to 12 months to achieve these targets. Now, let's do some calculations. The risk in this trade is 20 rupees, but the potential reward is 60 rupees. This means the risk-to-reward ratio is 1:3, which is very attractive, especially since the market is trading near an all-time high. That's all in this video. If you found our analysis helpful, please let us know in the comments. Don't forget to like, subscribe, and share this video with your friends. Remember, this information is for educational purposes only. It's not a buy or sell recommendation.